Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. Hope you all had a fantastic weekend. We're kicking off the week, October 27th, 2025, diving deep into the market buzz we've collected from yesterday.
That's right. Our AI has been busy sifting through a substantial number of discussions. We flagged quite a few different stocks today, and honestly, the overall sentiment is a real mixed bag. A lot of speculative optimism, but also some serious caution on the fundamentals.
All right, let's jump right into it, starting with Beyond Meat, symbol BYND. It's certainly generated a lot of conversation, with some users really hoping for another big run. They're pointing to potential short squeezes and, that meme stock energy. We've seen it surge before after a Walmart deal, and some were saying if it ripped once, it can do it again.
Well, Ethan, while that speculative optimism is definitely out there, our AI-generated insights show some glaring red flags. The KPIs are frankly abysmal. We're talking deeply negative revenue growth, a net profit margin that's firmly in the red, and a concerning negative price-to-book ratio. This company is struggling fundamentally, and the recent surge and plunge illustrates pure speculative volatility, not underlying business improvement. It was previously rated stay away and speculative gamble.
So, a lot of buzz, but the numbers are tough. What's the verdict?
Given the severe financial distress, BYND is a clear stay away.
Next up, we have Strive Inc., ticker ASST. This one saw some really aggressive bullish sentiment, with users actively encouraging others to pump the volume for huge profit opportunities. It sounds like a community-driven play, dismissing traditional analysis.
And that dismissal of traditional analysis is exactly why we need to be cautious. The KPIs for AST paint a stark picture: zero net profit margin, negative earnings per share, and an astronomically high debt-to-equity ratio of over 40. Perhaps most alarming is a negative price-to-book ratio, indicating liabilities outweigh assets. This company is in significant financial peril. Its previous rating was stay away.
Strong sentiment, but the numbers don't support it. Verdict?
Stay away. The underlying financials are far too risky.
Moving on to UiPath Inc., PATH. The initial post was quite bullish, predicting a 20% rip and highlighting partnerships. Some users were really hopeful about its potential in automation.
However, Ethan, the community discussions quickly shifted to skepticism. Many comments called it out as a potential pump and dump, and our KPIs confirm significant overvaluation. We're looking at a staggering price-to-earnings ratio of nearly 550, combined with a very thin net profit margin of just 1.3%. This indicates the market has priced in an enormous amount of future growth that isn't currently supported by profitability. It's been consistently rated stay away or speculative gamble previously.
Yikes, 550 PE is certainly a number to chew on. So what's our take?
Stay away. The valuation is simply too disconnected from current performance.
All right, Alamos Gold Inc., AGI, generated some discussion around the broader AI bubble sentiment. While some users were skeptical about AI profitability, AGI as a company, isn't a pure AI play. Some news pointed to positive corporate performance.
That's an important distinction, Ethan. But even for a company outside the direct AI sector, the perceived market bubble creates risks. AGI has a high PE ratio of almost 39 and a very high debt-to-equity ratio of 7.469. In a market where a correction is widely discussed, a highly valued and indebted company like this is vulnerable. AGI has never been previously rated.
So, caution remains king, even for non-AI plays caught in the AI wave?
Absolutely. For AGI, it's a stay away.
Up next, POET Technologies, POET. There's a lot of confidence in their long-term technology, especially for AI data centers. Users are seeing recent dilution as a strategic move, particularly with news of an oversubscribed direct offering and a new $5 million order for optical engines.
While the tech sounds promising, Ethan, the financial reality is stark. POT is currently unprofitable, with zero net profit margin, negative EPS, and a highly negative operating margin. Its price-to-book ratio is incredibly high of over 14, meaning it's valued far beyond its tangible assets based purely on future expectations. Plus, a significant debt-to-equity ratio of nearly 15 adds to the risk. POT has mostly been a stay-away or speculative gamble in prior analyses.
So, a long-term vision, but no short-term numbers to back it up. Precisely?
For POT, it's a stay-away.
Let's talk about Hims and Hers Health Inc., HIMS. This one's generating a lot of bullish energy. Users are excited about its diversification into weight loss, women's health, and mental health, calling it the Amazon of health subscriptions. There's also talk of high short interest and a pre-earnings rebound.
It's true the revenue growth is impressive at over 72%, Ethan, but the risks here are substantial. HIMs carries an alarmingly high debt-to-equity ratio of over 185, which is a massive financial fragility. Additionally, its price-to-earnings ratio is over 61, meaning the stock is priced for perfection. While expansion is good, this level of debt and valuation demands extreme caution. HIMs has also been a stay-away or speculative gamble in past discussions.
So, growth, but with significant baggage. What's the call?
Stay away. The financial risks outweigh the speculative growth potential.
Finally, Nebius Group NV, NBIS. This stock has seen a huge run-up, and while there's short-term concern about a lockup expiry causing a dip, there's a really strong long-term bullish sentiment. Users are expecting huge earnings and are planning to buy on dips, especially with news of an AI Cloud 3.0 and potential Microsoft partnership.
The long-term outlook is interesting, I agree, Ethan, especially with that significant revenue growth. However, in the short term, the impending lockup expiry could flood the market with shares, leading to a substantial price drop. The stock's PE ratio of over 150 is extremely high, pricing in massive future growth, and a debt-to-equity ratio of over 32 adds another layer of financial risk. Previous ratings have mostly been stay away.
So, potential future, but immediate turbulence. Yes, we're flagging NBIS as a cautious buy, specifically if you're looking to enter on those anticipated dips rather than at its current high valuation. All right, let's quickly recap our AI-generated insights for deeper investigation today. Investigate as buy? None. Investigate as cautious buy? Nebius Group NV, NBIS. Investigate as speculative gamble? Beyond Meat, Inc.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for joining us on the Daily Hunt for Multibaggers, and we'll catch you next time.